Welcome back to the Advisor Strategy Room. This is Brett Waterfield with my trusted co-host, Travis. Travis, how are you?
You know what, Brett? I'm doing all right. We've got foggy skies from all the wildfires in Canada. I can't eat lettuce, so salads are out. But other than that, today's the first day of the Open. So me personally, I can't really complain. How are you doing?
I'm doing good. I went for a walk this morning. It was a little warm and didn't realize that the smoke had come down into our area. But and I got to say, I didn't know that you were a big salad eater anyway. So
Well, you can tell?
part of the health regimen, I guess.
Yeah, exactly. It's okay to have some greens every once in a while with the meat.
Yeah, gotta. Well, we got a fun topic for our episode today. It's breaking down today's recruiting deals. So transition packages, it seems to be a hot topic out there of everybody's hearing about these big deals, these record setting deals, and advisors are calling and asking about, is it true, is it not? And so we wanted to have a conversation, kind of maybe demystifying it a little bit, digging into how firms do transition deals, what they're looking at, what these deals are, what they're not. So exciting topic.
Yeah, no, I think just kind of starting from that point, what are they? These firms are making an investment in an advisor. So what are they not? They're not free money, right? So the bigger the deal, essentially, the more efficient or expedient the payback, right, is probably going to be. So I think that's something to really maybe start with, is just kind of, Brett, if you could maybe walk us through, how are these deals structured and how are firms making money off of them in the long run?
Yeah, I think, there's always the question about, hey, my friend got a deal and it's, X. And sometimes advisors are surprised when their deal is better or upset when their deal is not so good, and they don't understand, why they're not all equal. And so when these firms, like you said, they're making an investment in the advisor, and the firms all have some level of an ROI that they're hoping to achieve based on the advisor's business moving over to their platform and the economics they're going to make. What's that ROI and what are they willing to invest to get that ROI and to get the advisor to move over. And it's not just what is your gross revenue. It's not just what are your assets under management. They dig into revenue. What revenue's coming from advisory business? What revenue's coming from brokerage business? What type of products are the advisors using for their clients' investments? And so ultimately, when it breaks down, you can kind of see how firms make their money, and where the more profitable an advisor's business is, the way they run their business, the more profitable that is to a firm, the more they're going to pay in transition money. So in general, most firms are more attracted to fee-based business. And a lot of them will put parameters to get their highest offers. You need to be 60, 70, 80% fee-based, whether that's revenue or assets, depends on the firm and depending on how that firm makes their money. If they're self-clearing, the economics are probably driven by the assets more than the revenue. And if they're not self-clearing, it might be driven more by the revenue than the assets. So
Sure.
How do they make their money? What business makes them the more money? Well, advisory business tends to be stickier, more consistent, so it's more attractive, so they're willing to pay more for that. Then it's what assets sit on a platform that they're either revenuing sharing with or that they own the platform. So mutual funds that sit on the platform are going to be more attractive than direct business mutual funds. So whenever an asset is held on the platform, that's going to be more attractive. So TAMPs, 401ks, things like that are not held on the platform. They drive some revenue. So revenue-driven firms are going to maybe pay more than, asset-driven firms might not even look at that business. So it's really the composition of the business that the advisor runs with the firm that they're looking at and evaluating, and how does their business drive revenue for that firm. And that's why you could have two advisors both doing $1 million in production. One's heavy fee-based, the other one's heavy mutual funds. They're not going to get the same offer, not even close.
Yeah. And I've seen that happen a lot. Or even, they'll get different offers from different firms, just kind of based on everything you just said. And I also want to touch on a little bit of how these firms are evaluating books. Another huge factor is going to be client portability. Yeah. So if you're coming from an independent firm, going to an independent firm, the thought process is you own all of your client data. 99% of your clients are going to come with you. The ones that you're leaving behind, maybe you want to leave behind. But if you're coming from the wirehouse world or a captive firm, a lot of going to an independent broker dealer, right? A lot of these firms are going to factor in what they would call a breakage, or, they're going to look at last 2 years of advisors who had moved from your firm, and they have some number, and every firm is different, of assets that they've successfully moved over. And then they're going to kind of discount your assets or your revenue to that amount. So that can play a huge factor in what a firm is willing to offer as well.
Yeah. I mean, it raises an interesting question for advisors, especially if you're coming from the bank world or from any W-2 world, let's just say, to the independent world. Most of the time, it's not going to be disclosed what breakage they calculated into this. So they might start and say, hey, we're paying 100%. Oh, if we paid the whole thing, it's $1 million of a transition package, but we're going to apply breakage, and so maybe it's $700,000 or what have you.
Yep.
They don't typically disclose what that breakage is, but if you asked about it, you actually might get a sense for their confidence level in moving an advisor from where you are to their platform. Because again, this is an investment, and nothing shows you a level of confidence, regardless of what they say, than where they'll put their dollars.
Yeah.
And if it's a heavy breakage, then they're basically saying we don't have a lot of confidence in moving your business over.
And I've seen it too, where say you're coming from that captive W-2 world, there are sort of atypical or more higher standard advisors. So tenure at the firm, level of assets, level of advisory assets that are going to allow you to maybe get a deal that's above the standard amount of breakage that firms will look at too. They'll look at the advisor and the book itself, but just know that if that's sort of what you're searching for is an IBD breakaway, that's kind of how these firms are looking at the business.
Yeah, I think the IBDs looking at a breakaway are going to definitely look at the advisor. They're going to look at growth rate. They're going to look at composition of clients, composition of the book. How many, households.
Yep.
How many of those households are, say, over $1 million? Things like that. There's ways that they're going to start dissecting that book to see if they suspect the breakage, or if they're betting on the breakage being less than typical. So. Yeah. But, what we're also seeing out there with these transition deals and why they're getting bigger, and there's a whole host of reasons why they're rising. I started off, in not recruiting, was recruiting earlier than this, but in the IBD space with recruiting deals, 18 plus years ago, where we used to offer $10,000 or, something very minimal, and there was no note. It was just free money.
Yeah.
Because the risk was very low. But then deals started and competition between firms started getting bigger and more cutthroat, to say, so to speak. And so how do we give more money? And as the dollar amounts crept up, the introduction of forgivable notes, which has been popular more on the W-2 and the wirehouse side, got introduced. And it used to be a 3-year note. Then it was a 5-year note. Now you're lucky if you can find a 7-year note. Most of the notes these days are 10-year notes. So the dollars have gone up, but they've had to tie it to forgivable notes to protect themselves, because as the dollar amount goes up, the break-even years goes up. And to get that ROI, they need to, make certain that the advisor doesn't jump ship or leave again before this time, or they got to pay back the money, right?
Yep.
So
the
dollars have gone up, but so has the term on these deals has gone up.
Yeah, they want to keep you there for a certain amount of time because again, they're looking at this as an investment in you. So they've got their even, they've got their ROI like you talked about. But I want to maybe go over, so we talked a lot about the upfront money, but let's talk maybe a little bit more about what else is included in an offer. You'll typically have an upfront amount, you'll have what I would call a headline payout amount, and then you'll have maybe some growth bonuses, or you might hear them called back end bonuses. You'll have typically your platform fees. So this is maybe part of the ways that these firms are making money off of you. But there's a lot of different factors. And again, I would describe all of these as sort of headline numbers. So if you might see a 90% payout on your offer, right, but your platform fees are anywhere from 5 to call it 15 basis points, well, that's not a net 90, right? So help me, maybe if you could just give an example of an offer that you've seen recently to help our listeners understand how these are portrayed in an offer, and then maybe some behind the scenes what's going on and the levers that we can pull.
Yeah, I mean, I think you could see, it's not uncommon to see situations where two firms come in and they're both, the payout is, call it 90, and one transition check is, say, 80% of trailing 12, and the other's transition check is 120% of trailing 12. And how they're both 90% payouts. Why is this firm willing to pay so much more than the other firm? And the one at 80% of trailing 12 just can't budge. And sometimes that's where some confusion comes in. Then you dig back below the surface, like you said, what are the admin fees? The 80% transition check comes with a 5 basis point admin fee on their fee-based platform, and the 120 comes with a 15 basis point, hypothetically. Yep. And so it's not just one firm being more generous or one firm liking you more than the other firm likes you. So there's typically, they're making the money back somewhere. And so it's very uncommon, not impossible, depending on situational periods of time and what's going on with a specific firm in a specific market conditions. They might get aggressive, overly aggressive, ultimately lowering the ROI expected.
Or and do this a big event, a merger, for example, which we saw last year. Yeah.
But typically, you're never going to find the highest transition check with the highest payout with the lowest ongoing cost in economics. You can't win
something somewhere. Yeah,
exactly. And so advisors typically will have to weigh, do I want more upfront money or better ongoing economics? And that's where you start to get into the levers you talked about, is and some firms are easier to work with than others to do this, but can I trade back transition money, so to speak? You offered me $1 million in transition money and you're offering me a 90% payout and 8 basis point admin fee. Okay, well, if I take 800,000 instead of $1 million, will you give me a 91 or a 92%? Or will you give me 3 basis points? Or can I trade back some of that transition money to improve my ongoing economics? And probably the smart thing to do is to, if you are planning on staying at that firm for a long period of time beyond the transition note, trading for ongoing economics is probably ultimately the better payoff.
If you plan on growing, if you're moving to a firm to grow, I mean, that's just going to double, triple, make such a huge difference once you get to year 10 versus, in your example, the initial 200 grand difference. I mean, that's, it's a no brainer really, if you don't need that 200 grand to make the move.
Right. So there's, the other thing you could potentially trade back transition money for is fixed costs. Can we pay for E&O? Can we pay for technology? Are there fixed costs at that firm that I can prepay, so to speak, with transition money? So There's different levers you can pull. Theoretically, you can also take a lower payout and try to get more money.
Yeah.
Or you can extend the term. Some firms will say, hey, this is how much we're going to give you on an 8-year forgivable note. And you ask for more, and we'll give you that, but now you're going to 10 years, 11 years. You know,
and,
so you have to be thoughtful of that.
And now we even have firms that offer an 8 and a 10 from the get-go. And there is a difference in the upfront amount as well. Just a couple other things in an offer that I've seen recently is we talked about some of these back-end bonuses. You know, so what a firm essentially is going to do is they're going to take a snapshot of your AUM, where you're at now, and then maybe 12 months from now, they're going to say, okay, any net new assets over this threshold, we're going to pay you, call it 50 basis points on. Okay.
Yep.
So that sounds great. But what advisors sometimes don't realize, or maybe what isn't communicated to them, is after that 1 year is up and they want to take that sort of growth, you know, call it a forgivable growth loan, they're now obligated. They're signing up for a new note, 7 years or 10 years. And some firms will even offer it 24, 36 months. Mm-hmm. So what may have started as a 7-year deal, if you're growing and taking all of your growth bonuses, now after the last one, you're in a 10-year deal.
Right.
So definitely something to keep an eye out and look for, as well as, you know, these forgivable loans, how they're structured, the amortization schedule.
Yeah.
Some firms do it equally every year. So for example, if it's a 10-year deal, you get $1 million. $100,000 of that is forgiven each year. Whereas I've also seen firms that will structure it weighted toward the back end. And so keep in mind, you know, when you're getting these deals, you're getting them as a loan. And then each year you're with the firm, 1/10 of that amount is being forgiven and paid to you in a bonus, but you've already got the money. So essentially you're just being taxed on it as a bonus of principal plus interest. So every firm's going to have their own interest rate that they use. So that's important to know. And then every firm is going to maybe amortize this deal a different way. And where that could come into play for as a negative is if after 5 years you decide, I don't want to be at this firm anymore. And in your mind, you think you've got half of your loan forgiven, but really it was weighted, you know, 80% in the last 3 years or 70% in the last 3 years. Well, you owe a lot back more. Yeah. You owe back a lot more money than you had originally thought. So just not that these are deal breakers by any means, but just something for you to understand going forward, so that 3 years, 4 years into your relationship with this firm, you have an idea of what's an exit strategy if you need one.
Yeah. And a lot of those firms that back end amortize those deals, they'll level it out. You just got to ask.
Yeah. And this is our standard deal, but if you want it leveled out, yeah.
Yeah, exactly. Yeah. And so the back ends, you know, I think you hit on it. This isn't free money. This is all tied to a note. There's a term you have to stay there. And then every year, a certain amount of it's going to be forgiven and taxed as ordinary income.
Yep, that's good point as well.
Right. So plus the phantom interest that you're getting taxed on as well. So, you know, when you go into this, you're getting a very attractive amount of money up front, but understand it's going to be taxed. Now, I do think one of the interesting things about this business is, and I think we're seeing a lot of firms kind of close the gap on each other. The delta between some firms isn't as great as it used to be. And there's an opportunity, especially in a market like today, where an advisor who really wants to grow and wants to invest in growth, picking the right partner. So going back to feel and fit in our due diligence structure, not just the financials, but who's going to give me tools or access to tools and things to grow my business. You can essentially recapitalize your business through transition, get a transition check, and then invest that money in things to help you grow, which potentially could be write-offs. Again, we're not CPAs, as disclosed previously on other episodes. But if you can write those off to offset if you're growing at 5% and you can get a transition check and you can invest it in certain ways to accelerate your growth, and now all of a sudden you're growing at 8% a year, over the next 20 years, 15 years, 10 years, the value of your practice has gone up significantly. And then ultimately at that sale would be taxed as long-term capital gains. So,
Yep.
To be able to have somebody inject millions of dollars into your business without giving up any ownership in your business. I mean, I don't know. I'm sure there's probably other businesses that are like this, but I think it's somewhat unique to financial advisors to say, hey,
Absolutely.
I want to grow. Okay, we'll give you $2 million that you can use to help invest in growth.
And it's still your business.
And it's still 100% your business.
Right.
It's kind of fascinating.
It is. Yeah.
So I think advisors looking at transition as an engine for growth is a huge opportunity. Looking, and growth could be using that money to go buy other practices. It could be buying real estate. It could be investing in staff. It could be investing in technology or infrastructure, or whatever.
Whatever growth means to you, it's different for every advisor.
Yep. Yeah. I think the other interesting component that we're seeing now, and it's not widely available, but there are firms that we're seeing now where you can take a portion of the transition money in equity or profit units in the company that you're moving to. And then there's a vesting schedule to that. And so then you limit the cash, which is taxed as ordinary income, and take equity units that could be taxed as long-term capital gains when you sell them down the road, right?
Yeah.
So getting creative. And I think that's really driven by the fact that if we look at the wirehouses, they're going to pay the most money, then the IBDs, and now this RIA world where the operating expenses annually are probably the lowest, but they typically are going to pay significantly less in transition money. And so I think some RIAs are getting creative with these equity stakes to say, hey, we'll give you equity. We'll give you some cash, but we're going to give you equity because it's cheaper. It's easier for them to do that than pay cash.
Of course.
So,
but the thing to watch out there, and maybe this is a good topic for a whole nother episode, is we've started to see sort of headlines around this equity. So, what exactly is it? How liquid is it? How is the firm doing their valuation? When you hear equity, it's exciting, and not to say that it's a negative, but I do think it is sort of a key word to cause you to pause and kind of dig deeper into the equity part. And again, we can save that for another episode because it is relatively new into this sort of RIA world where firms are offering up the equity. So it'll be interesting to see how that sort of evolves and plays out over the next 5 years or so.
Yeah, I think it's definitely important if that's part of the deal to dig into, how are you valuing this?
Yeah.
And I think we talked about it in our previous episode with Jeff Nash when we talked about M&A stuff is the equity being given priced at book value? Is it priced at some future market value? How are you pricing this? And so, is it really worth what I think it's worth?
Yeah.
So.
Yeah. Anything else, Brett, that you could think of? I mean, again, this discussion was around an offer. Going back to one of our original episodes, we preach the feel fit financials, but because offers that are at an all-time high, they're sort of top of mind. There's a lot of myths, there's a lot of rumors, there's a lot of headline numbers that advisors are seeing out there, whether that's in the news or maybe on LinkedIn. But anything else that you think would be important for advisors to know just before they even start the recruiting process, just to kind of set expectations?
Yeah, I mean, I would say that is the transition package money out there at an all-time high. It feels like it is.
Yep.
It is
for the
true.
right book.
Yeah, for the right business. But select firms out there are willing to pay more than we've really seen in decades. So that is true. But your book has to be structured a certain way. It's going to come with term. It could be amortized in an unfavorable fashion. It is taxable. It's not free money, and there are caveats. And so I think going into it, understanding, there's a lot of money to be had in a transition package, but there are stipulations to this money. It is not free money. And these are firms making an investment in you being a client of theirs. and the money that they're going to make off of you over this period of time. And so the how your business is structured, how you work with clients, how you invest is going to drive that. So I don't think either of us want to say it's all negative and it's all smoke and mirrors.
No, of course not.
There's great deals out there, and
It's
there's
real
not.
money. I mean, I've seen it. Advisors get the wires with the money.
Yeah.
And it's not, and it to your point earlier, they still own the business. I mean, that's the beauty of this thing. They're still independent business owners, and they're getting a capital loan for a large sum of money that, to your point, they can use to fuel their growth. So that's
Right.
definitely a positive. But I guess what we're trying to say is just there are nuances behind the scenes
Absolutely.
that you just want to make sure that you're aware of.
Yeah. And I think more importantly, understanding that there's a lot that goes into these transition packages and understanding how they get to the numbers that they got to. And then there's things that aren't in the package that drive some of that. And so understanding the underlying economics, because you could be getting a lot of money, but just paying it back forever. But more importantly is the feel and the fit, right? So you take this great check, the biggest check out there, find out that they're charging you exorbitant fees 2 to 3 years into a deal, but you're in it for 10, 12 years. The feel is horrible. The service is horrible.
Yeah.
They made accommodations to service your business because of the way you manage money or serve your clients. And they're running into constant problems with your business. So every month there's service related issues because of accommodations, and it's just round peg in a square hole. That check was not going to be worth it. And so I think we both agree that going back and saying feel and fit, make sure those are good, verify those, and then look at the economics as kind of, if I talk to 6 firms and I've narrowed it down to 2 and I'm really torn between those 2 firms, then I base the decision maybe on the economics and say, okay,
Sure.
if I would be happy at either one of these firms, where am I getting the better deal and where's the better financials? Then that makes sense. But choosing it from the first thing and only thing, I think you're in for a world of hurt.
Yeah, and I've seen it before, right? And I mean, the good part is, right, if you're going from IBD to IBD, you can find another firm in 6 months to move to, but now you just disrupted your business. You've made your clients repaper, and you're going to put them through that again, which I've seen happen. I mean, that does happen. But again, I think what you're trying to say and what the overall message is of how we approach due diligence is use Fuel Fit financials to make a smart decision where on the other end of it, you're going to be in a better place.
And we're in a unique time right now where folks that moved maybe 5 years ago and still have years remaining on a note probably moved at a time where the market was paying maybe half of what it's paying today.
And maybe half the term though, 5 years ago. I mean,
yeah. But so there's an opportunity almost right now. If you're stuck in a situation where the feel and the fit is not good, but you still have term remaining,
right,
you can almost essentially refinance that with a new transition note because the deals are so much bigger than they were 5 years ago, 3 years ago, that you would be able to pay off the remainder and get some money and get into a better situation from a feel and a fit standpoint. Versus the inverse, which we've seen in the past, where you took a deal, now deals have pulled back, and nobody can buy you out of that deal.
Right.
Like you're literally stuck. So for advisors out there who feel like they took a deal years ago and the feel and the fit is not good, like the market has given you an opportunity to essentially refinance that deal with a firm that is more aligned with you feel and fit wise. And it's not, I think you and I are both having conversations with advisors that are along that lines right now, and because of the opportunity the market is presenting.
Yeah. Yeah. I mean, to relate back to another episode is why are advisors moving? I'd say in the past, moving for the money wasn't necessarily a thing, or maybe it was a thing. But I mean, again, going back to how this is a positive, it's free cash flow. It's, it's investing in your business. It's growing. It may not be worth it to move for the money, but it sure would be worth it to explore just to see, see what your business is worth and see how it could help fuel your growth.
Absolutely. Well, Travis, this was a fun conversation. I know we talk about this stuff on a regular basis. You know, we've got our hands on it. We're everybody at Bridgemark. We text probably daily about what offers we're seeing, things like that. So any advisor ever wants to just see what's going on in the marketplace, what they think that what a transition package or even an M&A offer for their book might look like, give myself or Travis a call. We'd love to have those conversations with you. But appreciate your time today, Travis. Absolutely. It's always fun to see you.
Absolutely. And thanks everyone for listening. Hopefully all this smoke gets cleared up in a couple of days here in the Midwest.
Sounds good. Hey, who's your pick for the
the Open Championship?
The Open.
Well, first of all, unpopular take.
First of all, it's kind of cheating because we're already, when we recorded this, we're through
it's round a Thursday. I honestly haven't been watching that much of it. My unpopular opinion is this is the worst of all the majors. I just don't like the links golf look. Europe, the United Kingdom, they might have founded golf, but I think America's really taken it to the next level. If you just look at Augusta National, I mean, the Masters is a perfect major. Anyway, say all that to say, gosh, I don't even know. I'm going to go with Chris Gotterup because he seems to be on a roll lately. How about you?
I like your pick. I like your pick. I mean, I feel like we did an episode right before the U.S. Open, I think it was, and Jeff Nash picked Scotty Scheffler and almost pulled it out.
Yeah.
So I think he was just off by a major. So I think Scotty might pull this one off. Yeah.
Okay. All right. One of the favorites. I see how you do. All right, Brett. Well, thanks. And thanks everyone for listening. We'll see you next time.
Take care.